Please download the GCA app if you're not done already, and you can put up your questions up there. The next topic is for C4, concurrent session, is IFRS 17, insights from an end-to-end implementation. So as we gather here, we embark on a journey through the intricacies and challenges of adopting IFRS 17 within the Indian insurance industry. Today, we have the privilege of delving into the real-world experiences and invaluable insights gained from navigating the complexities of the transformative accounting standard. So now I would like to invite our session chair, Mr. Manoj Kumar Chhatlani, Joint Director, IRDAI, on stage. Mr. Manoj has been working as a Joint Director and leads the Finance and Investment Department at IRDAI. He has 12 years of experience as a qualified actuary and over 23 years of experience in the industry. As speaker, first we have Ms. Aarti Arora, Director-Actuarial Services, MetLife, GOSC. Aarti is responsible for IFRS 17 and VNB reporting within global actuarial modeling. She has over 15 years of experience across ALM, actuarial valuation and modeling. Our next speaker is Ms. Kanchan Gupta, Director Actuarial Services, MetLife GOSC. Kanchan leads actuarial reporting and analytics within MetLife Europe. She has over 15 years of actuarial experience spanning actuarial model management, shareholder value reporting, and regulatory reporting. Now I hand over the podium to the session chair.
Good afternoon, everyone. The tone of IFRS has already been set in my earlier session, so I don't have too much to add. The only thing is that if I go to back to the basics of IFRS, IFRS is basically an accounting standard, like any other standard. But what is the need of IFRS? The need of IFRS is basically it's a principle-based approach. So what are the principles? Principles are clarity, relevance, reliance. So IFRS is being implemented across the globe to provide a consistent balance sheet across the globe for all the investors to see into it and provide timely decisions. In India, in IRDA, there is a mission mode team of IFRS, and we are planning to implement IFRS by 2025, hopefully. And we have also asked about 15 companies to, to do the pilot run for that. I would say, this IFRS, implementing IFRS will give us, will give the international investors, they will say that, why we need IFRS, because it's required to have a faith in, balance sheet of the companies, which is not there at this point in time, because the gaps, Indian GAAP, US GAAP, all the gaps have different regulatory regimes, and they are governed by their respective regulators. So IFRS will give a consistent picture across the globe. So today, we have already discussed about the challenges being faced by IFRS team. Today, this team is basically gave us to provide an overview of adoption process of challenges associated with the IFRS 17. They have hands-on experience in implementation of IFRS with their respective clients. So I request you to please, take it over and provide an overview of that. Thank you.
Thank you so much, Manoj. Hi, everyone. So many of you would have just attended the previous session on IFRS 17. And I think that formed an interesting introduction for our session coincidentally. What Kanchan and I will be focusing today, sharing the IFRS 17 end-to-end implementation insights from the journey that we have been through. Our journey spans over more than 15 countries, and today we would like to share our learnings with you from the journey that we have gone through. So can we have the slides, please? Okay, thank you. So moving to the next slide. Thank you. So I will be covering mostly on the inputs, data, modeling architecture, and the downstream process. However, Kanchan will be covering the reporting part. So to begin with, transition approach and transition year. Many of you in this room must be aware about what our different transition approaches are. And I'm not here to cover the technicalities of these approaches. In MetLife, we have taken a blend of full retrospective and fair value approach. So the business written pre-2018, we have taken the fair value approach, and post-2018, we have taken the full retrospective approach. Now the question comes, why we have taken this blend of approaches? Because the data availability challenge with the full retrospective approach, especially for the business written many, many years ago. So that's why we have opted a blend of this approach. In your case, you can consider any of these approaches, but I would suggest you first check your in-house factors in terms of data availability, its quality, past assumptions, and the computation power and time before deciding on any approach and discussing it with regulators. On transition year, IASB has prescribed guidelines that transition year should be 1 year before my actual implementation. So if the actual implementation is 2023, for example, then my transition year should be 2022, so that they can see 2 years of comparative annual financial statements. The reason I'm discussing here on the transition year, as it's very simple as per the IASB standards, I'm talking about our journey and it spans over multiple countries. And if any one regulator change their requirements, you have to change the transition year and you have to follow all the process back from start till the end. So that's why one should keep an eye to detail. What should be the transition year? Should keeping a detail where any requirements are changing so that you can incorporate those requirements back to your process. Moving to methodology, modeling, and assumptions. Understanding the product feature is essential for IFRS 17, given the complexity of IFRS 17. And for actuaries, it's not a difficult job at all. Then why I'm discussing it here? Because sometimes our base contract has different measurement model, for example, GMM, VFA, and PA. And my rider is mapped to a different measurement model. So a decision needs to be taken here, which approach you want to model your base and rider, whether you want to model your rider together with your base contract, or you want to model it separately. So a decision needs to be taken over here. So one should go through all the product features before doing this mapping. And this is a very important exercise because it requires the whole process of looking at your efforts in terms of what all products you have, what products features you have. So you need to budget for an estimate that is required in terms of mapping these product features with their relevant measurement models. And the estimation in terms of efforts required here should not be underestimated. Similarly, on the modeling architecture, the effort here is significant. How you will lay out the modeling architecture from start till end. In MetLife, we have 2 profit libraries. One is MetLife in-house library, which is used for the projection of my liability cash flows. On top of that, we have FIS standard library that is used for my calculation of CSM, RA, and cohorting of results. Now, question comes again, why we have taken this modular approach? Because we want some flexibility, given we have to work on multiple countries. So we want some flexibility so that whenever product portfolio change for any particular country, we have a separate library to see the projection of cash flows. Along with that, we want certain standardization in terms of how my cohorting will be happening and how my results will be publishing and how my CSM will be calculated. So that's why we have taken this blend of approach. Your approach might be different based on the scope of the IFRS 17 implementation you have. Another important factors that one should consider before starting the modeling architecture is coverage unit and risk adjustment. IFRS 17 standard is not prescribed in detail what should be your coverage unit and which calculation method you should use for the calculation of risk adjustment. So if I'll talk about coverage unit, in case of term product with only death benefit, coverage unit can be your sum assured. However, in case of accidental and illness, product coverage unit can be the amount payable at the time of insured event. So you should need to understand what should be your product feature so that you can map it to the appropriate coverage unit. Otherwise, you will observe an absurd movement in the results. And we were fortunate because we made that mistake, but we were fortunate that we caught that mistake at the time of our model testing, and then we figured it out what should be the correct coverage unit for some products. On risk adjustment, we have different calculation methods for risk adjustment, cost of capital, value at risk. So an enterprise level decision needs to be taken, what should be your correct method for the calculation of risk adjustment. If I talk about risk adjustment stresses, it's purely depend on the company's economic capital methodology. So in-house factors such as your portfolio, nature of risk, and how it is impacting your entire business should be taken into consideration before deciding your stresses. And then you can propose it to your regulators that these are the stresses that you would like to take along with your thought process behind it. Also, my modeling architecture should be linked to my downstream tools, so that when I'm getting the output from my model, my downstream tools should be efficient enough, and it can automatically update my IFRS 17 disclosures and exhibit requirement. And it may sound simple and straightforward to implement, and many of you would have thought about various tools and templates that you can pull out for the publishing of this information. But the real challenge comes with the huge quantity of data we have with IFRS 17 and how you want to store that data in an appropriate manner so that downstream tools can be updated automatically. In MetLife, to overcome this challenge, we actually went ahead and created a result data mart. It's a huge data repository which contains the results of all our IFRS 17 countries in a standardized format, like in terms of product portfolio, in terms of cohorting, variable, multiple other things. And creating that data mart is not easy. So if you are planning to consider something like that, one should keep into account two things. One is the design specification, how you want to create that data mart, and that should be done at the start of the process. Another thing is, so IFRS 17 is an iterative process. And it's not like once you have done something, it's completely smooth. You may have to go back from start and then revisit everything. So the second thing, we want an agile modeling approach so that whenever my model is changing for any particular country, I can update my data mart, result data mart accordingly. So this is a classic case of agile approach. And I would like to call out a very good example where we faced. So when we were close to completing, I would say 15 countries implementation, we thought we are set in the process, we have models, we have result data mart, and everything is fine. But then came a new country, and that country have a different approach. Other countries are following the calendar year approach, however, the new country is on fiscal year approach. That means I need to restructure my data, make changes in the model, as well as my downstream tools. So one should definitely understand these requirements from the start and start laying out this architecture from the beginning of this program. On the data side, I know we have talked about on the results data mart and other things. In this slide, I will cover a bit more about data. And everybody knows insurers need a robust data management strategy to manage the IFRS 17 complexity. And I'm not going to state what are the data requirements on IFRS 17. What I actually want to mention, two specific examples. First one is on profitability tagging. So we spent, I think, almost 3 to 4 months in terms of understanding how we will tag different products and its groups into on-risk and non-on-risk contract. And once we submitted this information to the auditors, they requested us more granularity in the approach. And then we had to revisit our profitability tagging, which I mentioned, it's a time-consuming process. We had to divide our subgroups into, groups into multiple subgroups. And then on those subgroups, we have to tag whether it's profitable or non-profitable. So it's a huge exercise. Second example is on the contract boundaries. Unlike Solvency II, IFRS 17 contract boundary definition is not very prescriptive. It for my paid-up premium and the future premium. So one needs to assess what should be the contract boundary definition. The reason why I'm stating these two examples, because if there is any change in terms of data requirement in these two examples, it's not only impacting we as an actuaries, and it's not a small tweak in our model and the downstream stuff. It will impact your technology partner with whom you are working in creating all these things. So you have to go from scratch, starting from your data extract, and then before creating your MPS. So it's a huge process. So to do this, you need a great amount of collaboration with your IT partners and other team members. So whatever decision you need to arrive at a consensus, I would request you to do it at the start of the process, then your journey will be very easy. I will now hand it over to Kanchan to discuss his inputs.
Once my colleague Aarti and her team delivers the result, my team comes in picture. We are the recipients. We have to own and justify the numbers. One may think that a lot of effort goes in deployment of the model. That is partly true, because significant effort also goes in justifying the numbers and getting the IFRS 17 models and processes audited. This has been our experience, which is what I'm going to share with you today. When modeling team delivers the results, they work towards specification to deliver what they understand. But from reporting standpoint, we have to justify the numbers, because there can be different perspectives. Obviously, one check can be the basic check to ensure your data controls are there, check that all assumptions are there, check the different components of the reported matrices are correct. We evolved during our roadmap of 15 countries that for complex products and cohorts where you have doubt, creating an independent Excel-based model from first principle is useful. Those can be used to validate results against profit, but creating them from scratch is a time-consuming process. So you may want to prepare yourself thinking about these along with the deployment stage. Also, if you're already reporting under IFRS 4, think how we can compare the reported metrics under both the bases. So for example, UPR under PAA can be compared between IFRS 17 and IFRS 4. For CSM, ensure that components of CSM roll forward are correct, including A versus E variances. Getting comfort on A versus E variances is critical because it can have a large impact on CSM and therefore the LRC. We have some control over expected, but we have no control over actuals. I'll give you an example, but it might not extend to Indian companies, but if you're working for an organization which is operating with global footprints, this might interest you. So when we were focusing on setting up our systems, models on the expected basis, we assumed that actuals will flow in the same data definitions as expected. However, for some of the countries we operate in, there was so much data insufficiency in terms of the policy admin system that we did not get the actuals data. So we got the total claims data. We did not get it segregated into the deaths, maturities, lapses, surrenders. We had to formalize a strategy to put it in different buckets. Obviously, we went to IT team, we spoke to claims team if we can get the data in at least the bare minimum level of granularity, but we didn't get it. So we had to formalize a strategy to put it in different buckets. So there are two learnings from this. One, question your assumption. And second, start collaborating early in the process with IT, claims, operations, finance. Also, to get comfort on A versus E variances, you can think of doing experience analysis more regularly, maybe quarterly, that will serve as an independent proof to explain the A versus E variances you're seeing in IFRS 17. All these analysis, justifications, explanation on A versus E variances helped in getting comfort to the chief actuary. Next, if I talk about auditors and regulators, there is a lot of effort that goes in the audits and getting the models signed off by the auditors. We've gone through close to 20 plus audits, and experience for none of them was easy. The details the auditors can get into is not just what has been done, how it has been done, but even why a particular methodology has been followed. And this being the first audit of IFRS 17, you cannot predict the nature and the scope of queries that can come up. And post-implementation, we did not expect that a lot of queries will come and we'll have a lot of discussions with auditors. So there was a lot of to and fro which happened with the auditors. I'll show you some of the common theme of queries which we received from the auditors. These were some of the common queries which we received from different auditors, and there was a lot of discussion which happened. So the challenge was not in answering the queries, what has been happened, how it has been happened, but since there is so much deliberation that happens within the actuarial, we think our due diligence is enough. When we prepared these documents, even we thought that we prepared it good enough for the auditors, but the due diligence we did was not sufficient for auditors. So when you prepare your documents, you may want to prepare them with a view of showing to the auditors. One more real challenge I think most of you will be able to relate will be people changed role. So this project being a long-term project, people who were associated in setting up the methodology, in doing all the calculation, they either left the organization or changed the roles. So we had the answers, but we did not have the artifacts to validate our justification. So you may want to document early in the process and don't wait until last to document things. Also, discussions with the auditors on the methodologies and justifications can start much earlier in the audit process. You don't need to wait for the auditors to audit the results, and when they come up with the questions, then you answer. This can be started much earlier in the process. One of the most interesting challenges with IFRS 17 is correcting errors. So unlike previous regimes, you cannot hold an outside model adjustment. You will have to do multiple reruns, in fact, especially due to the manner in which CSM crystallizes, at least from the transition lane. So for example, if you've identified an issue in Q2 2023, but with the transition date of Q4 2021, so you'll have to do all the reruns from Q4 2021 until Q2 2023 to correct your opening and also for correct comparatives. So this means potentially sourcing the data, correcting the model, rerunning, validating the results. That means a lot of team, Aarti's team and my team will have to do. So if nothing else you take away from this session, one of the thing is what I want to say in summary is left shift all your controls, all your justifications, all your investigations as much as possible. Thank you.
Hello. Yeah, thank you so much for the insightful session. Just wanted to understand that one of the things you said was very important is the documentation part. So from the auditor's perspective, what kind of documentation you thought that that was missing when they interacted with you? Can you please give a brief light on that?
So so obviously the top queries were there. So we had to compare IFRS 17 and IFRS 4. So checking the assumptions against the both. They even wanted documents for that. And even against the reported existing basis for which we were reporting. So comparison of the reported matrix between the existing reserves and the IFRS 17. And even like the artifact. So we had laid down the approach, what has been done and all that. But how did we ensure that what we are doing is correct is something which we had to learn through the process.
Just want to add on it, on the modeling standpoint. So I think auditors want each and everything. So they want a complete documentation in terms of what approach we are following. And for that, we have a IFRS 17 manual in place that what modeling architecture we are using and why we are using. Along with that, they want the documentation in terms of our, for each and every country, they want the documentation related to the model. We call it at model release documentation. And the example that I gave on the result data mart, they want to assess how much controlled our results is. That's another reason we have created this result data mart, because we don't want anybody to overwrite or did anything wrong with the information. So these are the things they specifically request for that.
So did they ask for any impact study, like if something went wrong in one of the results? So did they ask you to rerun the model and give the revised results?
Yes. So I think currently we are...
So for that, we'll have to be ready. I mean, you know,
yes.
She said that we have to unlock from, say, 2021 to 2023 and take the opening figure and then reinstating the figures and all. Thank you very much. And from the audiences, if we can, the openness forum for the question and answers, please. Can we open the app also? Is it through mic or what? So just one last question, like what are the key challenges you face in terms of implementing those IFRS into the system?
Okay, I'll start from the scratch. I think one of the biggest challenges is creating the in-house expertise. Okay. Because when we came to know that we have to do this IFRS 17 implementation, that too for so many countries, at that time we didn't have in-house expertise, but now I think we have good in-house expertise. So that's one of the biggest challenge, but once you have the expertise, I think you can sail the boat.
Thank you. Thank you very much for the session, and over to MC.
Thank you all. You have left us with a very insightful presentation. I would like to now invite Ms. Yogita Arora to give mementos to the chair and the speakers with a huge round of applause.